Have you ever noticed that the prices of things you buy seem to keep going up over time? It can be a real pain to budget your allowance or salary when everything seems to cost more and more. Even everyday items like sugar, onions, and spices are going up like crazy, leaving us scratching our heads and wondering where all our money is going. If you heard your parents or grandparents talk about how things used to be cheaper when they were younger, well, they're not just waxing nostalgic. It's because of inflation. Inflation is a topic that affects all of us, whether we realize it or not. But don't worry, in this video, we're going to break down everything you need to know about inflation. Let's first discuss what exactly inflation is. Inflation is a term used to describe the increase in the general price level of goods and services in an economy over time. In other words, it's the rate at which the cost of living goes up. You might have seen in the news how inflation rate changes. In the recent news, the UK has recently experienced an unexpected surge in inflation, with food prices reaching their highest rate in 45 years. This has put pressure on the Bank of England to increase interest rates again this week. What's the result of this? Household incomes are being squeezed as the Consumer Prices Index, or CPI, is accelerated to 10.4% last month, up from 10.1% in January. Prices have been driven higher by the increased cost of drinks, women's clothes, meals out, and fresh food due to the shortage of salad items. On the other hand, in the US, the inflation rate fell to 6% in February 2023, which was in line with market forecasts and the lowest since September 2021, down from 6.4% in January. There are many more news surrounding the internet regarding the inflation rates worldwide. Some countries' inflation rates rises while others fall for a short period of time. But what causes inflation in the first place? Demand outpacing supply is the root cause of inflation, but there is actually 6 underlying causes that we need to understand in order to fully grasp this economic phenomenon. First, there's demand pull inflation, which happens when there's an increase in demand for goods and services, but the supply doesn't keep up. This leads to an increase in prices as consumers compete for limited goods. To understand demand pull inflation, let's take a look at the basics of supply and demand. In a healthy economy, supply and demand are balanced, meaning that there is enough supply to meet the demands for goods and services. However, when demands for goods and services starts to increase rapidly, it can outpace the economy's ability to produce them. As a result, businesses may start to raise their prices in response to the increased demand. This increase in prices can create a vicious cycle. As prices rise, consumers may try to buy more goods and services before they become even more expensive, further increasing demand. This, in turn, puts even more pressure on the economy to produce more goods and services and can lead to even higher prices. Demand pull inflation can be caused by a variety of factors, such as an increase in consumer confidence or a decrease in interest rates that make borrowing money cheaper. It can also be driven by government policies that increase spending or stimulate the economy. Second, there's cost-push inflation, which is caused by a rise in production costs such as wages or raw materials, leading to higher prices to maintain profit margins. To understand cost-push inflation, let's take a look at the factors that drive production costs. There are many factors that can affect the cost of producing goods and services, including the cost of labor, raw materials, and energy. When these costs increase, it can become more expensive for businesses to produce their goods and services, and they may need to raise prices to maintain profitability. This increase in prices can create another vicious cycle. As prices rise, consumers may be less willing to purchase goods and services, which can lead to a decrease in demand. This, in turn, can put pressure on businesses to cut costs, which can sometimes mean reducing wages or laying off workers. These actions can further reduce demand, and the cycle of cost-push inflation continues. Cost-push inflation can be caused by a variety of factors, such as an increase in the price of oil or other raw materials, a shortage of skilled labor, or government regulations that increase the cost of doing business. In some cases, cost-push inflation can be a result of external events, such as natural disasters or geopolitical instability. Third, there's built-in inflation, which is a result of wage and price expectations being built into the economy. For example, if employees expect higher wages due to rising prices, businesses may raise prices to cover the extra costs, leading to a cycle of inflation. To understand built-in inflation, let's consider the relationship between wages and prices. When prices increase, workers may demand higher wages to maintain their standard of living. In response, businesses may raise their prices to cover the increased labor costs. This, in turn, can lead to even higher demands for higher wages, and the cycle of built-in inflation can continue. Built-in inflation can be caused by a variety of factors, such as strong labor unions, minimum wage laws, or cost of living adjustments in contracts. It can also be driven by expectations of future inflation, as people may adjust their behaviors and spending habits in anticipation of rising prices. Fourth, there's imported inflation, which happens when the price of imported goods goes up due to factors such as exchange rate fluctuations or tariffs. This can cause a ripple effect on the prices of domestically produced goods and services. To understand imported inflation, let's take a closer look at the factors that drive the cost of imported goods. There are many factors that can affect the cost of importing goods, including exchange rates, tariffs, and transportation costs. When the value of a country's currency decreases relative to the currency of the country from which the goods are being imported, it can become more expensive to purchase those goods. Additionally, if tariffs or transportation costs increase, it can further raise the price of imported goods. This increase in prices can create a vicious cycle. As the price of imported goods increases, businesses that rely on those goods may need to raise their prices to maintain profitability. This, in turn, can lead to higher prices for consumers. If the price of imported goods continues to rise, it can lead to further inflation and potentially harm the economy. Imported inflation can be caused by a variety of factors, such as changes in exchange rates, changes in government policies, or global supply chain disruptions. In some cases, imported inflation can be a result of external events such as natural disasters or geopolitical instability. Fifth, there's monetary inflation that occurs when there is an increase in the money supply of an economy, which can lead to a decrease in the purchasing power of each unit of currency. In other words, as more money is introduced into the economy, each individual unit of money becomes worth less, and prices for goods and services may increase. One of the primary drivers of monetary inflation is the central bank's monetary policy. When the central bank decides to increase the money supply, it can do so by engaging in a process called quantitative easing, which involves buying financial assets like government bonds to inject more money into the economy. This increase in the money supply can lead to an increase in demands for goods and services, which can drive up prices. In addition, when the money supply is increased, there is more money available for lending, which can lead to increased borrowing and further economic growth. However, if the increase in the money supply is not accompanied by a corresponding increase in production, it can lead to inflation. Monetary inflation can have both positive and negative effects on the economy. In the short term, it can help to stimulate economic growth and create jobs. However, if it is not managed properly, it can lead to hyperinflation, where prices rise so rapidly that the economy becomes unstable and may even collapse. Lastly, there's hyperinflation, which is a rapid and out-of-control increase in prices, often caused by a collapse in the economy or government mismanagement. Hyperinflation is an extreme form of inflation that occurs when prices rise at an astronomical rate, often exceeding 50% per month. This can lead to a complete breakdown of an economy and has devastating consequences for individuals and businesses alike. Hyperinflation can be caused by a variety of factors, such as excessive money printing, political instability, and a lack of confidence in a country's currency. In some cases, hyperinflation can be triggered by external events, such as a war or natural disaster. The consequences of hyperinflation can be severe. As prices rise rapidly, people's savings lose value and may become worthless. Businesses may be unable to operate due to the rapid rise in costs, and people may be unable to afford basic necessities such as food and shelter. This can lead to social unrest and political instability, further exacerbating the problem. One of the most infamous examples of hyperinflation occurred in Germany in the 1920s. In just a few years, the value of the German mark plummeted and prices rose at a staggering rate. People were forced to carry wheelbarrows full of money just to buy basic necessities, and the economy was left in shambles. Let's now explore the effects of inflation. Inflation can have a wide range of effects on individuals, businesses, and economies as a whole. One of the most immediate effects of inflation is that the purchasing power of money decreases, which means that it becomes more expensive to buy goods and services. As prices rise, consumers may need to spend more money to maintain their standard of living, which can lead to decreased savings and reduced investment. Inflation can also have an impact on businesses, particularly those that rely heavily on raw materials or energy. When the cost of production increases, businesses may need to raise prices to maintain profitability. This can lead to reduced demand for their goods and services, which can cause decreased revenue and potential job losses. In addition, inflation can have a significant impact on the economy as a whole. If inflation is too high or unstable, it can lead to economic instability and a decrease in confidence among investors. This can lead to a decrease in foreign investment and a decrease in the overall level of economic activity. So, what can we do to adapt to inflation? One strategy is to invest in assets that are likely to appreciate in value over time, such as real estate or stocks. Another strategy is to adjust spending habits and budgeting to accommodate higher prices for goods and services. This may involve cutting back on discretionary spending or finding ways to reduce the cost of necessary expenses. For businesses, it may be necessary to find ways to reduce production costs, such as by finding cheaper sources of raw materials or increasing efficiency through process improvements. Additionally, businesses may need to consider raising prices or adjusting their product mix to focus on higher margin products. In conclusion, inflation is a complex economic phenomenon that can have a range of effects on individuals, businesses, and economies. From demand-pull inflation to hyperinflation, understanding the different types of inflation and their causes is essential for making informed decisions about finances and investments. While it can be challenging to adapt to the effects of inflation, there are strategies that can help us to mitigate its impact and continue to thrive despite the challenges it presents. Whether it's investing in assets that appreciate in value, adjusting our spending habits, or finding ways to reduce production costs, we can take steps to prepare for and adapt to inflation. So, the next time you hear about inflation in the news, remember that it's not just an abstract concept that affects the economy as a whole. It has real-world implications for all of us. By staying informed and taking action, we can navigate the challenges of inflation and build a more secure financial future for ourselves and our families. If you found this video informative, don't forget to like and subscribe to our channel for more content about economics and finance. And as always, thank you for watching.